Welcome to Secure Money Mindset, the ultimate podcast for financial planning tips and strategies. Our episodes are designed to be concise and to the point, lasting no more than 30 minutes. Each episode features seasoned advisors from Secure Planning Group or an outside financial specialist discussing crucial issues and providing actions to consider when addressing your top financial concerns. We value honesty and transparency, meaning we present both the good and the bad news in a clear and concise manner. Our goal is to provide you with reliable insights and practical guidance. Be sure to hit the follow button to stay up to date with our latest episodes. For more information, please visit our website at securepg.net. Let's dive into this week's episode of Secure Money Mindset.
Hello, everybody. Welcome to Secure Money Mindset podcast. My name's John Simone. I'm the managing partner at Secure Planning Group. Today, I have with us David Foster. David's the senior vice president for advanced planning at the Simplicity Group. In the spirit of Halloween, we're unmasking the one big beautiful bill. Take a closer look at what's really inside it. Our goal today is to help you see which provisions are built to last, which disappear in the years to come. The most important thing is helping families and business owners to understand how to prepare for what's ahead. We're very lucky to have David here today from Simplicity. We're going to be asking David some questions about the bill and ways to be able to maneuver through it. So David, would you mind introducing yourself and talking a little bit about you?
Yeah, absolutely. Hey, thanks for having me. My name is David Foster, Senior Vice President of Advanced Planning with Simplicity Group. Generally, my role has been pretty much over the last 35 years to support advisors, financial advisors, investment advisors, attorneys, CPAs in areas that involve high net worth clients, ultra high net worth clients, business owners, sometimes the mass affluent, and a lot of different areas from estate planning to business succession planning, retirement planning, etc. And of late, it really includes the last 25 years, it's been a lot of reading tax code, because they keep changing it. And I think that's what we're here to talk about today. But we get a lot of changes to taxation, and that creates a lot of opportunities, hurdles, etc. So that's my role. I support folks like John all the time, kind of the guy behind the curtain. And so, yeah, that's my role. That's what I've been doing for the last 35 years. Happy to be here.
Thanks, David. So why don't we dive right in? First question is, what's the most meaningful treats in the bill and what's locked in for long term?
Yeah, absolutely. So I'll just go through a couple of them. There's no way to hit all of them. This thing was 900 pages. So I'll hit some of the most important ones for our clients out there. Number one, lower tax brackets that came from the 2017 Tax Act. They are made permanent. We'll talk about that word permanent a little bit later, if that actually exists. But for now, there's no sunset on that. Just lower tax brackets, same as it was before. Many Americans are going to avoid the rate increases that were scheduled to kick in 2026. And I'll say the same thing for corporations, C corporations specifically. If you're a C corporation business owner, your tax rates inside the corporation are going to stay at 21%. Higher standard deductions. So we're going to bump up a little bit. And this starts now. So it starts here 2025. So individually, $15,750. Married, $31,500 for a married couple filing together. So that's an advantageous for taxpayers. For the I'm going to call them ultra high net worth now. Estate taxes. The estate tax and gift tax exemption is being bumped up from the current $13.99 million up to $15 million next year, and then it'll be indexed after that. So a married couple can actually pass on via gift or through their estate $30 million free of estate and or gift taxes starting in 2026. That creates a lot of different opportunities for us because that's bumped up quite a lot over the last 10, 15, even 20 years or so. On the business side, there's a bunch of different things in there. I'll just hit on some of the highlights. There's a provision in the code called 1202 that allows a C corporation, only certain type, small, qualified subchapter or small businesses, they allows them to avoid capital gains tax. It used to be that you could do that. Again, it's only for C Corps, only for certain corporations. You could avoid, when you sold your shares, you could avoid $10 million of gain. You could take $10 million of gain and not pay tax on it. They bumped that up to $15 million. So that's one of those things that people don't know about. I get a lot of calls. Hey, Dave, I got a C corporation. We're gonna sell it. We want to avoid taxes. What do we do, et cetera? Sometime in the next 5 years. I tell them, well, first of all, check 1202. You might qualify. You actually might not have taxes, and that opens up some cash flow for to achieve some other goals. There's another provision called 199A for pass-throughs. So your S corporations, your LLCs, taxed as a partnership, that gave you, starting in 2017, a 20% deduction on qualified business income. And that was going to go away as well. But now that's been extended indefinitely, and that creates a lot more certainty for small business owners. So that's an advantage again. There's some other more complex parts of the code, bonus depreciation and Section 179 expensing. Those have been improved upon slightly and or just maintained. So again, some of those were going to go away. So a lot of what happened in what we call the OBBBA actually just extended what was in the 2017 Tax Act, but that creates some clarity and some certainty going forward, and puts people on a little bit more clearer ground for a little bit longer term planning. So that, basically we got businesses in there. We've got, high net worth folks that there's something in there for them. And, I just hit on just a few of the ones for your mass affluent and other folks who have financial planning needs.
That's great. So on the other side of that, where do you see the tricks, the areas that may surprise people?
Yeah, it's in the details. And I've been saying this every time I talk about this bill. Pay attention to the details. Some of the details, for example, are that the provisions in there may lapse. So what we would call sunset. They might actually sunset. I'll give you some examples. And I didn't talk about these when I talked about the good things about it. But for example, there's a $6,000 deduction for seniors above age 65. Again, there's a lot of details to it. If you have a certain adjusted gross income, doesn't apply to you, etc. But a $6,000 deduction. So that's a big tax break. It expires in 2028. So that's one of those things where you think, oh, you put that in the back of your head that I got this deduction, you start getting used to it and you don't realize that it goes away. So you need to plan for that. There's another couple other provisions in there. You can deduct up to $10,000 on, and again, not everyone, but up to $10,000 on a car loan, an auto loan, on the interest when you get an auto loan. You can deduct that. You can also deduct tips and overtime pay. And a lot of this has been very public, and you may have heard about it, but those provisions sunset in 2028. And a lot of them, some of these start in 2026, some in 2025, so you have to pay attention to that. If you're in a state that has high state taxes, property taxes, etc., you may have heard of the SALT tax. And that had been capped. Used to be a lot higher. In 2017, they capped it at $10,000. So you couldn't deduct anything above anything that's state and local taxes, anything above $10,000. Well, they bumped that the whole way up to $40,000. So that's an advantage for sure. That you're going to start hearing terms like non-grantor trust. That's where we're going to get into the knee-deep tax law. You can actually do more than $40,000. We can layer some of these things. If you're upper echelon and you've got a lot of state and local tax that you want to deduct, we can get you above $40,000 with some strategies. They're actually perfectly legitimate. They're in the code. And you're going to start hearing more about those kinds of things. Of note, I spent a lot of time in my career working with charitable organizations. I spent 8 years as an independent plan giving advisor for charities across the Mid-Atlantic area. So I know charities pretty well. And I took special note of some of the provisions in there on charities and getting a deduction. So everyone thinks, well, you can deduct any dollar you send to charity. That's not necessarily the case. You kind of have to break yourself into whether you itemize or you don't. And this particular bill has some things in there for both. So if you don't itemize on your tax returns, there's this new thing now coming out of this new bill that you can deduct $1,000 individually or $2,000 if you're married, starting in 2026. Again, you always have to pay attention to the date. And you couldn't do that before. Since 2017, you couldn't, if you didn't itemize, you're really not creating a charitable deduction. And because they bumped up the standard deduction so high before, fewer and fewer people itemized. So people were actually giving to charity and not getting any kind of a deduction. Well, now, even if you don't itemize, $1,000, $2,000 if you're married, so that's good. On the other hand, if you do itemize, they created two, what I'm going to call a cap, a floor and a cap, a floor and a ceiling. There's this provision in there that says the first 0.5%, if you calculate a number, that's 0.5% of your adjusted gross income. And I know this gets into the weeds of tax planning and things like that, but it is important to pay attention to it. The first 0.5% is not deductible. Why they came up with that number, I don't know. I have an idea because I'm a little bit of a tax nerd. They needed revenue. So everyone's always looking for here and there where we can find a little bit of revenue here so we can cut some taxes over there. The other one is if you're in the 37% tax bracket, that's only for people married filing jointly that are over, I think it's $750,000 of income now. So if you're making that kind of income, you're at a 37, everything above that's 37%. Well, for those people who give to charity, they put a ceiling on it. You can only take advantage of a deduction of 35%. The math is a little bit odd in there, but if you just follow through that, a little bit of a floor and a little bit of a ceiling when you make a charitable gift, whether or not you itemize or not itemize. So I took too long on that, but I think it's important. I'll give you a little tip on why I think it's important. In the 2017 Tax Act, they did a study and found that because of the 2017 Tax Act, charitable organizations received, in 2018, $20 billion less in charitable gifts and ongoing $16 billion less in charitable giving. So, $1 billion here, $1 billion there, it starts to impact charitable organizations. So it's important to pay attention to that side of things. I think that there's going to be a big push in the coming years from charitable organizations to, for their donors. So pay attention, watch your mail, watch your emails. That might be coming. So this, you asked for what are the tricks. It's the uncertainty of some of these different provisions. It's the lapsing, the sunsetting, the details. You might have heard that you can deduct something. Well, you make too much money to actually be able to do that. So there's pros, there's cons, there's good, there's bad, and it depends on, your particular fact pattern. A lot of good in there, but you have to pay attention to the details.
Right. So for families, what new tools or opportunities do you see the bill introduces?
Yeah, specifically families, with children, you've got this child savings account, also referred to as Trump accounts, from 2025, I believe, again, unfortunately, just through 2028. When you have a child, the government is going to put into this account for your child, $1,000. And you, as the family, can actually put in another $5,000. And your employer could put in $2,500. So what these are is, think of them as an IRA account, because from a tax perspective, they really act like an IRA account just for a newborn. So you can't start saving earlier than that unless you have a grandfather that creates a huge trust for your kids. For that child, they throw in $1,000, you can put in $5,000, and that's annually. So you could start building a retirement account. I know it sounds odd to talk about a retirement account for a child, but listen, without going too deep into the weeds, some of the retirement benefits in this country may be at risk going forward just because of economics, math, etc. And so I think this was kind of a way to respond to that, to say, listen, if you want to, you can start setting up your child now. So I think that was good for families, and also 529 plans. So that's, the retirement planning side of things. But what about sending them to college? We all know about 529 plans. What they've done is you can now cover a wider range of educational expenses, curriculum materials, tutoring, therapy, licensing programs, and it's more flexible than it's ever been. You can actually spend the money on K through 12. So they started off with a plain vanilla 529 plan many years ago, and it's grown, and this one adds to it. So if you looked at it before and it wasn't for you, revisit it under the new rules, because it's a pretty good way to save for the education of your kids. And as we all know, college education is not getting cheaper. Yeah, so those are some of the features that, for multi-generational planning, those two come to mind. I would say those are the two big ones for family with children.
Great. So with all the moving parts, what should families and business owners be doing now?
Yeah, so I'm going to say we had tax laws in 2001. I think every 3 to 5 years we've had substantial tax law changes, and I'll say the same thing today that I say every single time. After there's been a substantial tax law change, re-examine your financial, estate, and business goals. Everything that we do starts with goals. I get oftentimes asked questions, and I'll just receive a dump of facts. That doesn't help me solve your problems. I don't know what your problems are, because two people with the same fact pattern may have different goals. So re-examine your own goals. Where are you headed? What do you want to do from financial, retirement, education planning for sure, but estate planning, wealth transfer planning, and your business goals. When are you do you have an idea that you might want to exit the business? Do you have a buy-sell agreement? Re-examine those every single time there's a substantial tax law change, because there could be, and in this case, I think there is, many different opportunities, many things that may be available to you now that weren't before, and they may not be around forever. So next point is always plan around this 2028 sunset on some of those things that I mentioned. And I'll say this too. I used the word permanent before. There's no such thing as a permanent tax law. I think John will mention this as well. Every time we think that something's permanent, the next administration comes in and changes it. And we have more of this. I said before, I've been in this business for 35 years. My first 10 to 12, great. No new tax laws for the most part. The last 25 just been, it seems constant. So it's very, long-term planning becomes a little bit difficult. But if you have a professional advisor who's familiar with these and is up to date on this, you can find opportunities. There's niches in there depending upon your particular goals and fact pattern, et cetera. So plan around the sunsets. Some of them disappear. There's windows of opportunities in there. Business owners, for sure. I have found this already just in the few months that this has been implemented. A lot of them are re-examining whether or not they should change entity type. C to S, S to C, LLC to a C Corp, something along those lines. Because we have a little bit more permanency in the tax law on some of the corporate things, a few more opportunities. One of the things I didn't mention earlier is there's so many different things I didn't even mention. I don't want to get into it. There's planning device called an opportunity zone that we're going to have a window of here where you might not be able to do it, but it's going to open up again in 2027, which is substantial tax savings for some of the higher net worth folks that have higher incomes that they want to minimize taxes on. So business owners, pay attention, maybe sit with your financial advisors, CPAs, attorneys, and things like that. Run multi-year tax projections. I know that sounds like a word salad of things that nobody wants to do on the weekend, but multi-year tax projections, evaluate whether to accelerate or defer. That's a big issue. I get that. This morning I had a call just on this. The idea of whether I should, have taxes paid on income earlier. We constantly hear, I want to defer taxes. And oftentimes that's a good idea. Sometimes you want to pay them more now so you don't pay more tax on the growth later. So examine those things and work with your advisors on that. In that same vein,
That's similar like to the Roth conversions. Again, if you're going to be in a different tax bracket, there's, if this changes it or so on for wealth transfer purposes or even, your retirement later on.
100%. That was kind of my next point. So if you're an individual, consider Roth conversions. Pay the tax now so you'll never pay it later. And actually, so your family will never pay it later. If you're a business entity, consider staying. I'd say stay as a C corporation. I just had a conversation with someone who wanted to say they were always planned on changing to an S corporation. Like, you could do that, but you also continue to have Section 1202, so you may never pay a tax if you sell it. So what are your particular plans that will drive what you want to do? Pay tax now, pay taxes later. revisit estate and trust planning. So we've had 25 years of estate tax exemptions changing, mostly increasing. We had a year without an estate tax. We've had multiple changes going from $1 million to 3.5 to 5 to 10 to what it's going to be now, 15 million. Do you have an irrevocable life insurance trust? So I get that question all the time. I have an irrevocable life insurance trust. I know what it was for, to provide liquidity to pay for estate taxes. You may not have estate taxes anymore, but that first I and ILIT is irrevocable. There's more options in an irrevocable life insurance trust than most people realize. So examining those, work with an advisor that can help review those, see if it still accomplishes your goals, and see if there's not something you can do about it to help your new wealth transfer goals. Maybe there's been a divorce in the family. Maybe you've added grandchildren. There's a whole lot of things as time goes on and as tax laws change. You should always revisit those and take a look at those. So that's a big one. I'm going to spend a lot of time, I think, over the next 3 to 5 years for sure, re-examining irrevocable trusts to make sure that it still accomplishes family's goals. And I'll say this: this is one we only have a short window of time for this one, and that is consider if you're someone who typically gives to charitable organizations every single year, specifically a good amount every single year, you might want to consider accelerating your 2026 gifts into 2025. And the reason is for that I mentioned, we're adding this 0.5% floor and a 35% ceiling. That applies next year. You'd get a bigger tax deduction for the exact same gift this year than you would next year. And since next year is only a few months away, it's not a bad idea to consider that. So I've hit on a lot of different areas: business, estate, financial, retirement, charitable giving, and all those kind of things. In short, pay attention to the clock. Some opportunities that this bill creates may disappear when the clock runs out, and re-examine your own goals and work with an advisor who's capable of understanding what the tax laws just did and see if anything fits. You may, worst case scenario, you cement the idea that what you're currently doing works for you.
I think that's great. So, some final thoughts. You just probably mentioned what they were, but knowing that the bill is almost 900 pages long, what should people be doing? How should they make sure that this doesn't become too overwhelming?
Yeah, I just mentioned pay attention to the details. You don't have to be the expert. I know we're in an age of if your elbow hurts, you don't go to a doctor, you Google it. Okay, you may get good information, you may not. If you have you want to draft a will, you can go online and do it yourself. That's great. It may not fit your particular goals and objectives. You could, if you would like to, you can go Google. Maybe you have AI. Go take a look at what the OBBBA actually does. You're likely to get some misinformation. And I'll tell you why you might get some misinformation is because they always do this. Every new tax legislation, months leading up to it, there's a lot of information on what might be in it, what it might do. By the time that final version gets signed, there are so many changes. But the internet is filled with all that information that was bad. So I get it every single year. When there's a new tax legislation, I spend the next 3 to 6 months clearing it up. That information isn't good. Well, it's because someone went online and said, well, I found out this information. I heard you should do this. Speak to your professionals because they're up to date on what actually happened, number one. Number two, in every single tax law, every single law, frankly, there's ambiguities. They will spend the next 3 to 6 months, 9 months, 12 months, clarifying what was in there, creating regulations. First there'll be notices, there'll be IRS notices, then there'll be regulations, preliminary, then final, until we figure out exactly what it is. So use your advisors, I think, is the best thing that I can say, because their job is to pay attention to that. Again, I'm behind the scenes trying to help them be familiar with what's going on, where the opportunities are. Maybe don't operate on yourself, to use the medical terminology.
Well, David, I mean, we really appreciate you taking the time today to sit with us and kind of go through this super large bill. So, I mean, long story short, you said it. I think it's important to work with the right team of people because we have the resources that they don't have, right? We have access to somebody like yourself from And then also your other partners, the estate planning attorneys, CPAs, as you mentioned, it's really important to bring the entire team together to make sure everybody's on the same page and coordinating efforts together. So with that, I think it's important to understand the One Big Beautiful Bill Act isn't something to fear. It's something to understand. There's provisions there that can create some really, really good opportunities, but it's important to also know when they go away. So you got to take advantage of it and work with the right people. If you like any help reviewing the situation, the team at Secure Planning Group is there to guide you every step of the way. This way we can help you plan with confidence. Don't forget to check out any of the other Secure Money Mindset podcasts, wherever you see podcasts, or you can go to securepg.net. Thanks so much. And from the team here at SPG, we want to wish you a happy and healthy Halloween. Thanks again, David. Have a great day.
You bet. You too.